Hey everyone! In this video, I'm going to break down MLT's latest quarterly results and show you why this could be a golden opportunity for long-term investors. I'll explain the key numbers, analyze the risks, and help you decide if MLT deserves a spot in your portfolio. Let's dive in. Hey friends, welcome back to the channel. I'm Iggy here, and for those new to the channel, I've been analyzing REITs and stocks in Singapore for over 5 years. The investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with more than 800,000 reads. My REITs analysis videos have helped thousands of investors make better investment decisions. Let me expand on MLT's second quarter financial performance for FY 24/25. The numbers tell an interesting story of both challenges and resilience. Looking at the headline figures, Mapletree Logistics Trust recorded a gross revenue of 183.3 million Singapore dollars for the quarter, representing a 1.8% decline from the previous year. Their net property income also saw a modest decrease of 2.1%, coming in at 158.6 million Singapore dollars. The distribution per unit, which is particularly important for income-focused investors, dropped to 2.027 cents, marking a 10.6% reduction from the same period last year. However, these numbers deserve a deeper analysis. The trust's performance was influenced by several key factors that paint a more nuanced picture. The most significant impact came from their China portfolio, which experienced lower contributions amid the country's ongoing property market challenges and economic headwinds. Additionally, MLT executed a strategic portfolio optimization plan, which involved divesting several properties. While these divestments temporarily reduced rental income, they're part of a broader strategy to enhance portfolio quality. A third crucial factor was currency-related. The strengthening Singapore dollar against various Asian currencies created a headwind for overseas income when converted back to SGD. What's particularly noteworthy is that when viewed in local currency terms, the core business performance remained stable. This indicates that the underlying property operations are sound, and the current challenges are more related to external factors rather than fundamental operational issues. The trust maintains a healthy occupancy rate of 96%, demonstrating strong demand for their properties across most markets. Their proactive capital management approach has also kept their weighted average borrowing cost stable at 2.7% per annum, which is commendable in the current high-interest rate environment. What's particularly interesting about MLT's performance is how the numbers tell a different story when viewed in local currency terms. While the headline figures might appear concerning at first glance, the underlying business fundamentals remain remarkably stable. This stability is crucial because it demonstrates that MLT's core operations continue to perform well, despite external challenges like currency fluctuations and global economic headwinds. Looking at their impressive property portfolio, MLT has built a substantial presence across Asia-Pacific with 186 strategically located properties spanning 9 countries. This geographic diversification serves as a natural hedge against market-specific risks. Their portfolio occupancy rate has actually improved to 96%, which is particularly noteworthy given the current market conditions where many property trusts are struggling to maintain high occupancy levels. The rental reversion story is equally compelling. While the overall portfolio shows some pressure due to China's market conditions, the rest of the markets demonstrated robust growth with a positive rental reversion of 3.6% when excluding China. MLT's management has been proactively strengthening their portfolio through strategic acquisitions and redevelopment initiatives. Their recent acquisitions in Malaysia and Vietnam are particularly noteworthy, as these markets are experiencing rapid growth in e-commerce and modern logistics demand. The Malaysia acquisition, located in the prime logistics hub of Shah Alam, spans 127,442 square meters and is fully occupied. In Vietnam, they've secured 2 properties totaling over 120,000 square meters in key industrial zones near Hanoi and Ho Chi Minh City. These new assets are modern, ramp-up logistics facilities that cater to the growing needs of e-commerce and third-party logistics providers. Additionally, their ongoing redevelopment projects, particularly in Singapore and Malaysia, are transforming older warehouses into modern, multi-story logistics facilities with advanced specifications, which should command higher rents and attract quality tenants upon completion. On the financial front, Mapletree Logistics Trust continues to demonstrate strong financial discipline and prudent capital management. As of September 2024, their aggregate leverage ratio stands at 40.2%, which is well within the MAS regulatory limit of 50% for S-REITs. The trust has taken a conservative approach to interest rate risk by hedging 84% of their total debt of 5.55 billion Singapore dollars into fixed rates, providing significant protection against the current volatile interest rate environment. Their weighted average borrowing cost remains stable at 2.7% per annum, which is relatively competitive in today's market. The trust maintains a healthy interest coverage ratio of 3.5 times, indicating strong ability to meet their debt obligations. Furthermore, they've proactively hedged 77% of their distributable income for the next 12 months into Singapore dollars, protecting unit holders from currency fluctuations across their 9-country portfolio. Their debt maturity profile is well staggered with an average duration of 3.6 years, and they have secured 987 million Singapore dollars in available committed credit facilities to refinance upcoming debt maturities. The trust also maintains an investment-grade credit rating of BBB+ from Fitch, reflecting their strong financial position and conservative capital structure. This robust financial foundation positions MLT well to weather market uncertainties while maintaining flexibility for future growth opportunities. The outlook for MLT presents a complex mix of challenges and opportunities in the current economic landscape. China's economic growth has slowed to 4.7% in Q2 2024, below market expectations, primarily due to ongoing property sector issues and weak domestic demand. This slowdown directly impacts MLT's performance in the region, where they maintain significant portfolio exposure. The broader geopolitical tensions, particularly between China and Western economies, add another layer of uncertainty to regional trade and investment dynamics. On the financial front, MLT faces headwinds from rising interest rates and currency volatility. With their aggregate leverage at 40.2%, higher borrowing costs are putting pressure on distributions. The strengthening Singapore dollar against regional currencies, particularly the Japanese yen, Korean won, and Vietnamese dong, continues to impact overseas income when converted back to SGD. However, MLT's strategic focus on sustainability has become a bright spot in their portfolio management. They've made impressive strides in their green initiatives, expanding their self-funded solar generating capacity by 24% to reach 44.8 MWp. Their commitment to sustainability is further evidenced by the increase in green-certified space, which now encompasses 45% of their portfolio by gross floor area. This positions MLT well for the growing demand for environmentally responsible logistics facilities and potential green financing opportunities. The trust's geographic diversification across 9 countries provides some buffer against regional market volatility, while their high portfolio occupancy rate of 96% demonstrates the underlying strength of their asset management strategy. Their proactive approach to hedging, with 84% of debt either hedged or on fixed rates, helps mitigate some of the interest rate risks in the current environment. MLT's investment thesis presents a compelling long-term opportunity in the logistics sector. The trust has demonstrated strategic foresight by actively upgrading its portfolio, with recent acquisitions in high-growth markets like Malaysia and Vietnam. Their portfolio rejuvenation strategy includes divesting older properties at premium valuations while acquiring modern facilities in prime locations. This approach has already shown results, with the trust maintaining a healthy occupancy rate of 96% across its 186 properties. MLT's focus on sustainability is particularly noteworthy, with 45% of their portfolio now green certified and a clear roadmap to achieve carbon neutrality by 2030. The trust's geographical diversification across 9 countries provides natural hedging against regional economic fluctuations, while their strong presence in developed markets, approximately 70% of assets, offers stability. Despite current headwinds from China's market slowdown and currency pressures, MLT's fundamentals remain solid with a well-managed balance sheet, 84% of debt hedged at fixed rates, and a comfortable aggregate leverage of 40.2%. The current market weakness, which has pressured MLT's unit price, could indeed present an attractive entry point for investors with a long-term horizon. This is particularly relevant given the growing importance of logistics infrastructure in Asia, driven by e-commerce expansion, supply chain reorganization, and increasing regional trade integration. Patient investors who can look past the temporary challenges may find value in MLT's combination of stable income, growth potential, and commitment to sustainability. Before I wrap up, let me share something exciting. If you found this analysis helpful, you're going to love my deep dive video on Is Mapletree Logistics Trust, MLT, overhyped now despite 17% upside, where I break down their valuation and growth potential in detail. Click the link above to check it out. And if you're enjoying this kind of in-depth analysis, make sure to hit that like button and subscribe to the channel for more insights into Singapore REITs and stocks.